Hi, welcome back. In this video, we are going to talk about refinancing and how refinancing can actually substantially increase your net worth in a very short period of time, or simply allow you to keep your home, keep your family's home, and just provide a safety net for your family and be secure. Now, refinancing is when basically your home value has gone up since you purchased it. Maybe you bought it for $500,000 and now it's worth $700,000, but instead of just selling the property, you are actually using the appreciation and taking it out of the home in the form of a new first mortgage or a home equity line of credit, also called HELOC for short. Now keep in mind, a HELOC is a secured line of credit against your home. Many people may have an unsecured line of credit, which you get at a local credit union or a bank branch. Well, a secured line of credit against your home or a HELOC is actually cheaper than an unsecured line of credit. So many people get a secured line of credit or a HELOC because it's cheaper and you can actually get a larger amount of money. And both reasons are because your house is actually used as collateral. Now, refinancing, you're simply making a change to your mortgage and you're not selling your property. You're keeping your property there. You're not doing anything with it. You're just taking advantage of the annual appreciation. And this actually happens every 2, 4, 6, or 8 years, depending which market you're in. And this can be very beneficial for you. And it could actually save you a lot of money in taxes, depending on where you are. With a lot of new tax rules coming in and changes, many people are saying we'd rather keep our property and refinance so we don't have to pay any sort of taxes depending on what you do. But you may have to not pay any sort of taxes and you could actually pull the money out of your property and do multiple things with it. For example, you may want to renovate your current property. And that's very beneficial because you're actually taking money out of your home, you're renovating your current property, and now that's actually going to improve your property value. So that's a very, very good thing to do. Many others may consolidate debt. So you have a lot of high interest debt, credit card debt, maybe 20%. Now you're consolidating that and paying, between 4 and 5%, which are current market rates at this time. So you're saving a lot of money there. Or maybe you want to provide a financial gift to your family member because they want to purchase a home, son, daughter, brother, sister, or potentially you want to purchase a second home or an investment property or a vacation home. Or maybe you want to buy a vehicle because vehicle rates at a dealership may be too high and you want to pay a lower rate. So you could also buy a vehicle with those funds as well. So refinancing has many, many benefits if the funds are used correctly. Now, many people may say, well, Parm, why should I get a first mortgage? Should I actually get a HELOC instead? It all depends what your goals are and what you want to do with the money. Getting a first mortgage is beneficial because if everything is consolidated into the first mortgage, every month or bi-weekly as you pay your mortgage down, your principal goes down, your interest goes down. So this is very beneficial. We recommend this to all of our clients who are consolidating their debt. So we'll take, for example, their mortgage, their current first mortgage, and they have a lot of debt. We'll actually combine them together, get rid of all that debt. And now all of a sudden that high interest debt they're paying low interest on, they're paying the debt off every month. So over a 5-year period, their debt is actually going down. They're saving a lot of money on interest and their cash flow is improving because they don't have the debt payments and the first mortgage payments and things are much more organized. Now, it does make sense sometimes to get a home equity line of credit. The benefit of a home equity line of credit is that maybe you don't know what you want to do with the funds yet. You don't have any immediate plans yet because if you increase your first mortgage all at once, as soon as your mortgage is done, it starts, you're actually paying interest as of day one on that amount. So I'll give you an example. Let's just say you have a mortgage of $450,000 and you want to increase that mortgage amount by $100,000 to $550,000. Well, as soon as your mortgage documents are signed, everything's completed, as of day one, you have to start your monthly mortgage payments on $550,000. But let's just say you don't need that $100,000 yet. You're not unsure what you want to do with that money. You just simply want to refinance because you want that safety net and you never know when you might need the funds or your financial picture may be changing soon, so you'd rather get approved today. Well, in that case, you're better off getting a home equity line of credit because you could get a home equity line of credit, keep the $100,000 on the side, and you won't pay any interest on that. You only pay interest on the funds as soon as you start using them. If you aren't using the funds, then there's no need, and a HELOC is actually one of the best options for that. So the HELOC is a great option, but again, it depends on the pros and cons, and you got to do a cost analysis. When it comes to refinancing, refinancing is typically done up to 80% of the value of your home. So I'll give you a very easy example. You may have purchased a home for $500,000. You put a 10% down payment. Your mortgage is roughly, $450,000, maybe a little bit more with the mortgage insurance premium. Well, you will have an insured mortgage because your mortgage has to be actually $400,000 for you to have an uninsured mortgage. Now, fast forward, your home might be worth $700,000. That's excellent. And you want to refinance, you want to take some equity out. Either you want to increase your first mortgage or you want to increase and get a home equity line of credit. Now, the way a refinance works is refinancing is you're allowed to go up to 80% of the value of your home. So you may have bought a property for $500,000 and you put a 10% down payment, so $50,000 plus the mortgage insurance premium. So your mortgage is actually just over $450,000. Well, if you have an insured mortgage, if it was uninsured, you'd actually have a $400,000 mortgage. That means you have at least 20% equity. Now, in this case, let's just say a $500,000 property, fast forward a few years, it goes to $700,000. Well, if you want to refinance up to 80% of $700,000, you could actually obtain a mortgage of $560,000. So let's just say over time, your mortgage has gone down to $425,000, for example, your original mortgage. Well, now, since the value of your property has gone up, you could take out over $100,000 just because your property has gone up in value. And you still got to qualify for that mortgage. Now, yeah, when refinancing, you still got to qualify under the mortgage rules at that time. But assuming if you do qualify, you could actually bump your mortgage up to 80% of the new value of the home. In this case, $700,000 is the value, up to $560,000. And that difference, you get that as a first mortgage or a HELOC. So that's a very easy way to kind of explain how refinancing works, how much equity you could take out of your property. Now, you could actually do both as well. You could actually obtain a new first mortgage and a home equity line of credit. So let's just say you will use $20,000. And if you are going to use $20,000, we recommend to all of our clients, put that $20,000 into your first mortgage because you don't want to just leave it in your HELOC and then use the money every HELOC and just make interest only payments every month. That's a waste. And there is actually a cost benefit analysis done on how long you should keep money in your HELOC for. But in this case, $20,000 sits in your first mortgage. And let's say you have $80,000 more available to take out or use or you're able to receive. You could actually take that $80,000 in a home equity line of credit. And then you use the $20,000 because your first mortgage has gone up and your $80,000 just sits there. Maybe you never use it, but that's okay. It just sits there and it's yours. And then another last tip I want to let you know about is if by any chance you do take a HELOC, and this is lender dependent, not every lender will do this. And basically, if you end up refinancing, you keep your first mortgage the same and take a new HELOC out, and you end up using $50,000 out of your HELOC. But now you actually know that you're not going to be paying that back anytime soon because in a HELOC, you could move money in and out as much as you want. It's a totally open product. If, for example, you have a $100,000 HELOC and you borrow $100,000, and let's just say 6 months from now, you could repay back $50,000. But maybe the next day after that, you could reborrow 10 more thousand. So you could do a fully open product. You could transfer money in and out. It does have a higher interest rate as stated earlier. And then you're only responsible for making the minimum only interest payment per month. That's what you're responsible for. When you get a new first mortgage, you're responsible for the principal and interest payment per month. Now, when it comes to just using your HELOC funds, a tip is, depending on the lender, you could actually, let's say you take out $50,000 of your $100,000, you're not going to repay it back anytime soon. If you go down to your bank branch, you could actually lock that $50,000 that you borrow into a new term. And what that means is you're actually locking that into a first mortgage without requalifying again. And this is huge because your interest rates will go down, your mortgage payment, you actually have your mortgage payment will go up because now you'll have an actual mortgage payment. So you'll be paying principal and interest every month on that $50,000. So make sure you have enough cash flow and income. But if you do, then your rate will go down and your overall interest pay will go down. But before you do that, always check with your lender if you will lose your balance. So for example, if you have a $100,000 HELOC, you take $50,000 out, then put it into a fixed term portion. Double check with your lender if that $50,000 will be gone. So now if you do pay that back, you only have $50,000 more left in your HELOC. Well, I hope this video was very beneficial for you. refinancing is a very excellent option as long as the funds are used correctly and it's done correctly as well. There are many different ways to do a refinance because you don't want to increase your amortization too much. There are many cases where many borrowers will actually increase their amortization as well during a refinance because they want to decrease their monthly payment. For example, if you had your home for quite some time, maybe 15 years, and you only have 10 years left on your mortgage, but now you need some funds or you need help qualifying, you would actually extend the amortization out. But you don't want to extend it out too much because the longer the amortization, the more interest. And it depends on what your goals are. If your goal is to be mortgage free as soon as possible, you want the amortization to be smaller so you can reach your goal and be mortgage free as soon as possible. Well, thanks for tuning in. Don't forget to like, subscribe, share, and comment, and see you at our next video.